Record gold prices. Targets of $6,000, $6,300, even $7,500 per ounce. Is gold really headed that high in 2026? Some analysts say yes, not as a short-term blip, but as part of a deeper macro shift driving structural demand for the yellow metal. But before we jump ahead of ourselves, let's break down the real data, the forecasts, the drivers, and the risks, so you can tell fact from hype. Where gold is right now. Gold has already shattered expectations in recent years. In early 2026, gold surged above $5,000 per ounce, outperforming many traditional asset classes and stunning analysts. That performance isn't just about short-term trading. It reflects investors seeking a hedge against global uncertainty, currency moves, and shifting monetary policy. But when we talk about 2026 forecasts like $6,000 or even $6,300 per ounce, we're talking about forecasts that are ahead of even gold's record run. Let's break down what analysts are saying and why. Major bank forecasts for 2026, JPMorgan's bullish call. One of the most prominent forecasts comes from JPMorgan Chase, which recently revised its 2026 gold forecast. They now expect gold to reach around $6,300 per ounce by year-end 2026 and set an updated long-term valuation base near $4,500 per ounce. That's a dramatic shift from earlier projections and reflects what they describe as continued diversification trends, central bank purchases, and persistent macro uncertainty. Bank of America, BOFA, sees $6,000. Another big name, Bank of America, has stated that gold could climb to $6,000 per ounce within the next 12 months. BOFA's forecast is rooted in geopolitical risk, tariff uncertainty, and continued safe haven flows, all of which tend to drive demand for non-yielding assets like gold. UBS boosts targets too. UBS analysts also revised gold targets even higher, with models suggesting levels above $6,200 this year before a slight moderation into year-end. Their scenario includes both bullish and bearish paths, with a potential upside above $7,000 per ounce in an extreme case. Independent forecasts put even bigger targets on the table. Brokerages like Motilal Oswal Financial Services have pointed toward a range between $6,000 to $7,500 per ounce over the course of 2026, framing gold's rally as part of a structural repricing phase rather than a short-term spike. That's a wide range, but it shows how analysts are extending their thinking beyond conventional models, why analysts are so bullish. So, what's driving these aggressive forecasts? Let's break down the real fundamentals powering 2026 gold outlooks. 1. Central bank demand. Central banks around the world, especially outside the US and Europe, have been accumulating gold reserves at high rates, both as a diversification strategy and to reduce exposure to any one currency system. This persistent buying supports a structural floor under prices. 2. Geopolitical and policy uncertainty. Inflation fears, fiscal deficits, and geopolitical tensions, including trade disputes and global conflict risks, push investors toward safe havens. Gold thrives in uncertainty. When confidence in paper assets erodes, demand for real assets tends to rise. This helps explain why gold has rallied even as other markets fluctuated. 3. Interest rate dynamics and Fed policies. Gold doesn't pay interest. So when real yields, interest rates minus inflation, are low or negative, gold becomes more attractive. Expectations of rate cuts or sustained low real yields can support higher gold prices, a structural tailwind many analysts reference. 4. De-dollarization and currency diversification. As global monetary conditions evolve, some countries are diversifying reserves away from the US dollar into alternative assets, including gold. This movement adds systemic demand that could sustain higher price levels long after the current cycle. Scenario forecasts for 2026. Instead of a single price point, many analysts use bands or scenarios to capture gold's potential range. Here's how the main scenarios stack up. Bullish scenario. Year-end 2026, $6,000, $6,150 per ounce. Drivers: strong central bank purchases, low real yields, geopolitical risk, sustained safe haven demand. Base case. Year-end 2026, $5,500, $6,000. Drivers: steady demand, moderate risk flows, continued ETF inflows, controlled inflation. Bearish, moderate case. Year-end 2026, $4,500, $5,000. Drivers: stronger dollar, tighter monetary policy, supply increases, risk on markets reducing safe haven demand. Most forecasters agree that the average or consensus view still leans bullish, partly because gold's rally has already exceeded traditional expectations from previous years. You might be wondering, if gold is forecasted to hit $6,000 or more, should I rush in now? Not so fast. Let's break down the practical implications. Gold's primary value rarely comes from price appreciation alone. It functions as a hedge against inflation, a hedge against currency weakness, and a crisis asset during market stress. In many portfolios, gold's role is risk management first, performance second. Prices can be volatile. Even though forecasts project higher levels, gold may experience corrections, pullbacks, or periods of consolidation. Remember, markets rarely move in straight lines. Whether gold hits $6,000, $6,300, or $7,000, allocation size matters more than price levels for many long-term investors. Today's forecasts help frame expectations, not guarantee outcomes. Not all analysts are unanimously bullish. Some caution that rising interest rates may limit gold's appeal in certain macro scenarios. A strengthening US dollar could put downward pressure on prices. Supply increases or reduced demand from major holders could temper price growth. Even bullish banks often include bearish scenarios, and prudent investors pay attention to both. Gold doesn't move in isolation. Its path is interconnected with bond yields, currency markets, inflation expectations, equity valuations, geopolitical risk premiums. For example, a weak dollar generally boosts gold prices because it makes gold cheaper for global buyers. Conversely, if global economic growth accelerates with strong confidence, risk assets may outperform gold, possibly slowing its rally. Understanding these cross-market linkages is critical to reading the 2026 gold narrative correctly. Analysts increasingly describe gold not just as a commodity, but as a macroeconomic signal. That means its price reflects underlying themes like confidence in fiat currencies, central bank diversification trends, geopolitical uncertainty, monetary policy expectations. This is why analysts who were once skeptical are now elevating their forecasts higher, not because of short-term momentum, but because macro trends appear to be shifting in gold's favor. Will gold break psychological barriers? But analysts remind us, round numbers matter less than market structure, fundamentals, and demand dynamics. The $6,000 gold price isn't just a milestone. It could signal deeper shifts in how investors allocate risk and preserve capital in uncertain environments. So what's the takeaway? Here's a concise summary. Gold has already delivered an extraordinary rally, climbing above $5,000 in early 2026. Major banks and analysts are forecasting even higher prices, with year-end 2026 predictions ranging from $5,000 to $7,500 per ounce. Bullish drivers include central bank demand, safe haven flows, real yields, and macro risk themes. Risk scenarios still exist, including stronger dollar or tighter monetary policy, so diversification and timing matter. Prices alone don't tell the whole story. Understanding why gold could rise and the conditions that would support or hinder that move is what gives investors an edge. Before you go, tell us in the comments, do you think gold will break past $6,000 in 2026, or will it face a pullback? If you found this breakdown helpful, subscribe to the channel and share for more deep macro analysis.